While the world slept through holiday headlines and end-of-year noise, the real event happened where the silver system either works or fails. Not on a chart. In the vault corridors, in the delivery queues, in the places where metal either shows up or it doesn't. Because today, the screen is telling you silver is $74 on Comex, but the physical market is telling you something else. Shanghai is printing $85. That's not a premium. That's not a temporary divergence. That is a full-scale dislocation. When the spread between East and West stretches into double digits, it stops being a trade. It becomes a stress signal. It becomes a credibility test. And it becomes a countdown. Tonight, we're going to break down what London is empty actually means in practice, why the arbitrage bridge is failing mechanically, why Shanghai is now setting the functional price, and why the panic has already started, even if most people can't see it yet. Because in commodity markets, the panic doesn't begin when price spikes. It begins when delivery confidence cracks. And that is exactly what a Shanghai $85 print versus Comex $74 is telling you. The first rule, paper prices can stay calm while the system breaks. If you've watched silver long enough, you've seen the same movie. The Western price looks controlled, the chart moves like a suggestion, and the headlines say volatile, speculative, overbought. But the physical market doesn't care about RSI. It cares about one question. Can you deliver? When supply is abundant, that question is boring. When supply is tight, that question becomes the entire market. And the reason the title matters, London is empty, is because London is not just a place on the map. London is a pricing hub, a storage hub, a transfer hub. It's part of the pipeline that connects mined production, refined bars, and global delivery. When that hub stops flowing, whether from real inventory tightness, allocation constraints, lease stress, or logistics, then the Western paper quote can become detached from the physical reality. That's how you get a scenario where the West is showing $74 while Shanghai is paying $85. It's not that Shanghai is overpaying, it's that Shanghai is paying the clearing price for metal that arrives. Let's quantify the dislocation. $85 for $74 is not normal. Do the math. $85 minus $74 is $11 per ounce. A near 15% spread between two major pricing venues in a globally traded commodity is not a rounding error. It is a structural break. In a healthy market, a gap like this triggers a simple mechanism. Arbitrage. Buy where it's cheap, move the metal, sell where it's expensive. That activity should compress the gap fast. So if the gap is not compressing, or if it's expanding, there's only one conclusion. The arbitrage mechanism is impaired. And arbitrage doesn't break because traders forget how to trade. It breaks because the metal can't be sourced at the cheap price in sufficient size. The metal can't be moved in the time frame needed. The bar specs, approvals, or logistics make it non-fungible in practice. The financing or lease market is stressed. Raising cost of carry settlement behavior shifts toward delays or cash alternatives. Or the vault inventories that back confidence are already spoken for. This is why we're saying panic has started. Because panic in commodities is not screaming on Twitter. It's buyers paying up to remove delivery risk. And that's what $85 in Shanghai signals. London is empty doesn't mean zero bars. It means zero confidence. Let's be precise. When people say London is empty, they often don't mean literally no silver exists in the city. They mean something more important. The readily available float is tight, the unencumbered inventory is lower than believed, and the metal that exists is already pledged, allocated, or unavailable on normal terms. Delivery-led times stretch. Premiums rise quietly, and the system begins to ration, not with headlines, but with behavior. Rationing is subtle at first. It looks like minimum order size increased, delayed shipment windows, call for quote, we can't guarantee delivery date, we can offer you cash settlement, we can roll you forward, we can substitute product. Those are not neutral statements, those are symptoms of stress. And when stress hits the London-centric bullion pipeline, you see it where it hurts most. The spread between paper and physical begins to widen. Shanghai becomes the spotlight because Shanghai has industrial demand concentration, the type of demand that doesn't care about charts. Industrial buyers don't trade, they procure, and procurement is merciless. The psychology shift from price to availability. Here is the key pivot you should watch for. When buyers stop asking, how cheap can I get it? And start asking, can you guarantee delivery? The market has changed phase. The phase change is what the title is describing, not a rally, a regime shift. Because at that point, $85 doesn't feel expensive to an industrial buyer if the alternative is a shutdown, a broken contract, penalty clauses, lost customers, missed production targets. This is why inelastic demand matters. Inelastic doesn't mean infinite money. It means the demand does not fall fast enough to stop price from rising when supply is constrained. That's how commodities reprice violently. What happens next? 3 paths. Same destination. If Shanghai is at $85 and Comex is at $74, one of 3 things happens. Path 1, the West catches up. Comex gaps higher over a few sessions to compress the spread. This looks like a sudden repricing that shocks people who anchored to $74. Path 2, the system adds. Friction, margins go up, rules tighten, volatility controls appear. This can slow paper trading, but it doesn't create metal, and it often raises the perceived scarcity, making premiums worse. Path 3, physical premiums detach. Further, even if spot rises, retail wholesale premiums remain high. This is the paper up, physical still tight scenario that traps late buyers. All 3 paths imply the same conclusion. If the deliverable market is tight, the pressure resolves upward, not because anyone wants it, but because the system needs rationing. The 5 signals to watch in the next 24-72 hours. If you want to know whether this is stabilizing or snapping, watch these. 1. Shanghai open. Plus, hold. Does it hold near $85 after the initial shock? Holding is demand confirmation. 2. Western open reaction. Does Comex gap higher immediately, or does it try to ignore it? Ignoring while Shanghai holds is a credibility problem. 3. Physical premiums. If dealer premiums stay elevated or rise while spot moves, physical is still scarce. 4. Availability language. In stock versus pre-order. Ships today versus ships next month. Call for quote. This language is the truth. 5. Volatility on thin depth. Big moves on modest volume indicate liquidity vacuum, the precondition for violent gaps. These signals will tell you whether the panic narrative is real or just loud. The bottom line, this isn't about price, it's about control. If London's pipeline is stressed and Shanghai is bidding $85 while Comex shows $74, the market is telling you the same thing it always tells you in early squeeze phases. The tradable quote is losing authority, the deliverable price is gaining authority. And once the deliverable price gains authority, the system has 2 choices. Admit it quickly, gap up, or fight it longer, bigger snap later. Either way, the adjustment is not gentle. That's what panic has started means. Not that everyone is screaming. That the system has begun to behave differently. And when systems change behavior, the chart is always the last to know. Why Shanghai can print $85 while Comex shows $74. There are 2 different products being priced here. Comex is heavily dominated by paper flows, contracts that can be rolled, net positions, options hedging, algo liquidity, spread trading. All real, all tradable, yet not always anchored to immediate physical delivery pressure. Shanghai, in this context, is reflecting the market where delivery matters more intensely, especially for industrial users who will pay up to guarantee continuity. So the divergence can widen because the West can print liquidity, paper supply. The East is bidding for material, physical supply. That creates 2 prices, a tradable quote and a deliverable clearing price. When the system is healthy, they stay close. When the system is stressed, they separate. And when they separate by double digits, the message is simple. The deliverable market is tighter than the tradable market admits. The hidden accelerant, thin liquidity and trapped positioning. Now we add fuel. When the market is thin, holidays, year-end, reduced desk staffing, price becomes more sensitive. It takes less volume to move the quote. And when you combine that with heavy options positioning, you get a dangerous reflex. If price moves into a zone where dealers must hedge, they can become forced buyers. Forced buying is not opinion-based, it's mechanical, and mechanical flows can chase price. So here's the nightmare loop the system tries to avoid. Shanghai holds $85, physical bid stays high. Western paper opens at $74, $76, still behind. The spread becomes a headline. More buyers rush to lock supply. Western price starts gapping to catch up. Options, hedging forces more buying. Supply fears intensify. Premiums rise even if spot rises. People realize they can't buy at the screen price. Panic becomes visible. That's how a market snaps, not from one big buyer. From the system realizing all at once that the screen is stale. If the gap is $11, why isn't everyone arbitraging it? This is the core question, and the answer is the whole story. In theory, buy cheap in the West, ship to Shanghai, sell high, profit. In reality, arbitrage is constrained by time. Metal takes weeks to move, the gap can move in hours. Form. Bar specifications, approvals assay, and exchange deliverability rules matter. Availability. The cheap price may not be available in size for immediate physical takeout. Financing. Lease rates, cars carry costs, can rise under stress. Counterparty risk. When markets strain, you care who owes you metal, not what your app says. Policy friction. Export controls, customs, and capital frictions can slow flows. When those frictions grow, the arbitrage becomes less like risk-free money and more like a risk trade that can go wrong. And when arbitrage gets scared, spreads can persist. When spreads persist, they become self-reinforcing because the higher price, Shanghai, signals tighter physical conditions, which triggers even more procurement urgency. That is the panic beginning.